Hello, this is Eric DeCarbonell from MarketSkeptics.com. Today I'm going to discuss one of the government's most blatant frauds, selling default insurance or put options on its own debt in order to lower interest rates. In the second half of this video, I'll be looking at a Federal Reserve transcript from June 2003, in which the Fed plans to sell put options on Treasuries to lower long-term interest rates. Before getting into the fraud, I need to go through a quick explanation about interest rates and default insurance so that everyone can follow along. The biggest factor in determining interest rates is default risk. Default risk is the risk that the borrower will not repay the borrowed money. Normally, the greater the chance of default, the greater the interest rate investors demand. This is the famous risk-return trade-off. For example, junk bonds have a high risk of default and require a big risk premium. However, there is a big exception: borrowing money using default insurance. So here's an example of this exception. Using its ultimate savings account, Citibank is borrowing from the public at ridiculously low interest rates. Citibank is not a healthy bank. This is an institution that should be borrowing at junk bond rates. So why is an insolvent bank like Citibank able to borrow at 0.1% interest rate? Well, the answer to that is FDIC insurance. Citibank pays a small premium to the FDIC in exchange for a government guarantee, allowing Citibank to borrow for practically nothing. This FDIC insurance is a form of default insurance. It provides protection against default in exchange for a fee. As we saw with Citibank, default insurance can distort the market and lower interest rates for even the riskiest of borrowers. Because it makes risk disappear, default insurance is both popular and heavily abused. As a result, there are many different types of default insurance. The most famous of these are credit default swaps, which played a big role in the financial crisis. Credit default swaps are insurance-like contracts that promise to cover losses in the event of a default. The buyer pays premiums in return for peace of mind if a default happens. All these types of default insurance follow the same pattern. Someone pays an insurance premium in exchange for default protection. Understanding Wall Street is so much easier once you realize they give 10 different names to the same thing. The demand guarantee is used to provide protection against default. The standby letter of credit is simply another term for demand guarantee. And private mortgage insurance is default insurance for mortgages. Finally, we have put options. Put options are a form of insurance that pays off if something crashes or defaults. They are widely used to protect portfolios. Now I want to talk about put options on Treasuries and how they've helped drive down interest rates. Right now, put options on Treasuries are extremely cheap. Financial advisors are recommending them because they're so inexpensive. These cheap put options have driven down interest rates by altering market perceptions. The cost of default insurance is used to judge the riskiness of debt, so cheap put options on Treasuries makes them seem safe, and people are willing to lend money for next to nothing if they believe it's safe. Cheap put options have also altered supply and demand. One way this is happening is that investors are buying put options instead of selling their bond portfolio. You see, there's a lot of investors that are nervous about bonds right now, and they're wondering if it's time to get out. And the strategy being pitched to these investors is to hedge bond risk by buying protected put options. The basic idea is to offset portfolio losses with gains from the put option. In other words, just like millions of Americans are keeping their money in insolvent banks and trusting deposit insurance to protect them, wealthy investors and the people managing your retirement savings are keeping all their money in bonds and trusting put options to protect them. Now imagine what would happen to Citibank if people lost confidence in the FDIC. Well, the same thing would happen in the Treasury market if people lost confidence in put options. Cheap put options have also created an entire class of investors who buy Treasury bonds and bet against them at the same time. For example, Nasib Taleb, author of The Black Swan, recommends shorting Treasuries by a somewhat complex strategy. It involves putting 90 to 95% of your capital in ultra-safe investments such as US Treasuries, and then using what's left to bet on the collapsed Treasury bonds via put options. Although investing 95% of your money in an asset class you believe is going to collapse might strike some people as being idiotic, a depressingly large number of people are following this strategy. And that's because put options are so cheap that investors are deciding they are the most cost-effective way to protect against a sharp rise in interest rates. Now let's discuss the fraud of selling default insurance on your own debt. Imagine for a second that you could go out into the market and sell put options on your own debt. This would let you 1. Drive down the risk premiums on your mortgage, credit card, etc. to zero, drastically lowering your interest rates. 2. Earn a premium for selling the put options. With enough put options, the income could exceed your interest payments, allowing you to earn money on your own debt. And even if you go bankrupt and default, the put options would become worthless, costing you nothing. What I've just described to you is fraud, and it's what the federal government is doing. Now it's finally time to turn to the June 2003 FOMC meeting transcript. The Federal Open Market Committee is responsible for open market operations. Open market operations refer to the purchases and sale the Fed makes, and are the principal tool for implementing monetary policy. The most detailed record of FOMC meeting proceedings is the transcript, and the transcript that interests us is the June 2003 meeting. And we'll be looking at the transcript and presentation materials. Here's the transcript, and here's the presentation material. Remember, this is straight from the Fed. Also, note the presence of Alan Greenspan and Ben Bernanke. Two other people I need to mention are Vincent Reinhardt, Secretary and Economist of the Federal Open Market Committee, and Dino Kos, Manager of the System Open Market Account, which means he's in charge of the Fed's open market operations. These two will be giving a presentation at this FOMC meeting. Greenspan starts off by getting the minutes of their last meeting approved, and then the presentation begins. The materials used in the presentation are in the separate PDF. The meeting is about conducting monetary policy at very low short-term interest rates. Reinhardt's Exhibit 1 shows how interest rates were at 1.25%, creating a credibility problem. Reinhardt outlines the concern that, because of these very low interest rates, the public is going to think the Fed has run out of ammunition. After all, if the Fed boosts the economy by lowering interest rates, how does it boost the economy once short-term interest rates reach zero? Reinhardt provides an easy answer to that question. After short-term rates are driven to zero, the Fed can still boost the economy by driving down long-term rates. Reinhardt then discusses policy alternatives to do this. Now let's skip ahead to Dino Kos's part of the presentation. After Vincent has finished reviewing the strategic aspects of conducting monetary policy at low interest rates, Mr. Dino Kos starts talking about the tactical issues the desk might confront in implementing policy once interest rates reach zero. Of special note, Dino says he'll restrict his remarks to operation in which the desk is currently authorized to transact. Vincent mentioned a possible strategy of maintaining short-term interest rates at low levels for a long period of time. Dino is going to discuss some of the tactical approaches that could support such a strategy. The alternative approaches that would involve changes to how the desk operates are summarized in Exhibit 4. These include extending the average maturity of outright holdings in SOMA, setting explicit ceiling on long-term Treasury yields, and using derivative instruments. It's the use of derivative instruments, like put options, that interest us. But I want to quickly point out that the Fed has already done the first two. Dino's Exhibit number 6 presents a simple example of how an objective to extend the average maturity of the portfolio might be aggressively pursued. To extend the average maturity of the Fed's portfolio, the Fed could redeem $200 billion of bills over 6 months and buy long-term treasuries. The Fed has done this. See how the Fed has sold off its $200 billion in treasury bills and then replaced it with long-term treasury bonds, extending the average maturity of the Fed's assets? Next is setting ceilings on treasury yields. Presumably the ceilings would be announced. If not, market observers would soon come to recognize their existence and infer their level. Conventional outright purchases of treasury securities would be the primary operational mechanism to back up the ceilings. Quick search of Google Archive news results reveals that in March 2009, Federal Reserve Chairman Ben Bernanke established a ceiling on Treasury yields with a plan to buy $300 billion in government debt. For the last 2 years, the Federal Reserve has been capping Treasury yields through massive purchases of long-term Treasury debt. Now on to the Fed's use of derivative instruments. The committee could sanction the use of various derivative instruments on conventional desk operations as a way to influence longer-term yields. This is outlined in Exhibit 8. As we see here, the Fed is discussing selling put options on Treasury securities. We could sell put options on longer-term Treasury securities at strike prices associated with desired long-term yields. It is worth noting that auctioning derivatives is something the Fed already has experience doing. The sale of any options would not affect the domestic portfolio immediately. In other words, default insurance doesn't cost anything until someone defaults. However, when the Fed would have to make good on all these put options, the payouts would appear very visibly as losses on the income statement. Of course, a successful option program would be one in which the options sold are never exercised. The Fed's put options could be effective through several channels. First, even a relatively small program would undoubtedly add symbolic weight. Second, they would represent a monetary cost to the Federal Reserve from deviating from the implied path of future short-term rates. For this effect, the more options sold, the better. Third, a large volume of options sold could reduce the risk premiums embedded in longer-term rates, independent of the level of credibility about any policy commitment. Translation, even if people lose all faith in the Federal Reserve, selling these put options will still lower interest rates. Here too, the more options sold, the more effective. Ultimate success would hinge on the quantity of options sold, that is, how big a bet the Federal Reserve were willing to make. The more options sold, the greater the chance they would have the desired effect on long-term rates. But of course, the risk to the portfolio, to reserve levels, and of capital losses would rise in equal measure. And an exit strategy for options may not be as straightforward as it seems. A decision to stop selling more options would be interpreted in the market as a statement about future policy intentions. The resulting rush to unwind market positions would likely be very disruptive and send yields sharply higher. For those of you who have doubts about whether the Fed would sell put options to reduce risk premiums, I want to skip back quickly to Reinhardt's closing remarks. These policies are part of our history. The Federal Reserve has always appreciated the importance of correctly aligning market expectations about the economy. The system has also been willing to put its balance sheet at risk to encourage appropriate expectations about interest rates or to calm fears about funds availability. The desk sold options on RPs for the weeks around the century date change that totaled nearly $0.5 trillion of notional value. Exhibit 7 confirms this. The Federal Reserve has sold massive quantity of options to correctly align market expectations. This is selling insurance on your own debt. This is fraud. Why haven't you heard about this? Well, on the Fed's website, where they explain what they do, it states that the Fed historically has not engaged in forward or other derivative transactions. This is what you call a lie. It's surprising that the Fed has any credibility left. I also want to point out that options are not new. They've been around for hundreds of years, and every single option market in history has ended in widespread default, as investors with huge paper profits find that they can't cash in their options. So ask yourself, who exactly is selling all these cheap put options on Treasury bonds? And what happens when inflation pushes interest rates up?